I'm Dr. Patty Hatfield, and we're going to begin the unit on financial analysis. So here's our course objectives for Finance 622, and we're going to be hitting that second objective there that's highlighted in pink. So just to serve kind of as an introduction, what does financial analysis do for us? Okay, financial analysis is really an important tool. It serves as a financial map so that we kind of know what the health of the company is and we can make informed business decisions about the company. Also, it's important to study the financials of a company to kind of get a consideration of the risks of the company. Are they overly leveraged? Do they have a lot of business risk? Do their sales fluctuate a lot? Do their operating costs fluctuate a lot? So we can find that out as we look at the statements for the companies. So here are some questions that we can answer as we go through the financial statements, and in particularly the financial notes that go with the financial statements in the 10K reports. So there's questions that address strategy that are important, and you see the questions there. What are the future business prospects? What about the market? Is it expected to grow? Are the businesses what are the strengths and weaknesses of the businesses, and what strategic initiatives have they taken or do they plan to take in the future, and what are the opportunities and threats? So as you might expect, or what you can see in addition to what's needed to answer these questions, is you're going to need to know also about the industry. So to do a good financial analysis, you are going to have to do some research into the industry that your firm exists in, so you kind of have an idea of how healthy it is given its competitors and others that operate in that same industry. There's going to be questions that you can address regarding earnings. What's their earnings potential, performance? Are their current earnings sustainable? What drives their profitability? That's a really important question. What is the company's business model, and then what drives their profits? What do they need in order to be profitable? And are those drivers threatened, or how could they be threatened? And then estimates can be made about what you expect earnings growth to be maybe in the future. And again, that would go along with some research on the industry. Then we have questions that address financial condition. So what is their current financial condition? What's their current, what I usually call financial health? What risk and rewards does their finance structure portray? So again, if they're very leveraged, if they have very stable earnings, more leverage might be acceptable and it gives them lower financing cost. But then for a firm that has a lot of volatility in its earnings, you probably wouldn't want to see a firm like that take on a lot of leverage, because if they're not able to make those interest payments on debt, then they can be forced into bankruptcy. So you want to kind of assess the risk and rewards of their financing structure. Are the earnings vulnerable to variability? Do you see a lot of fluctuations? And do they possess the financial strength to overcome a period of poor profitability? So what if they have a bad year, a year or two or three? Do they have the pieces in place to be able to survive that? Some additional questions to consider, how does the company compare with its competitors both domestically and globally, and who are their competitors? For some firms, that's a difficult question to answer because there isn't another firm exactly like them. Amazon's a very good example of that. Who is Amazon's competitor? Well, they have competitors, plural, which consist of so many industries. So, at one time when Amazon was first into ebooks, their first competitor was Barnes & Noble. Now they're into obviously entertainment, products. So they, compete with Walmart. They compete with Hulu and Netflix. They compete on so many different things at so many different levels. Apple Music. So, how do you do a comparison with a company like that? Amazon's kind of a nightmare to try to analyze financially. But some of your companies that are more isolated in terms of one or two particular industries, it might be a little bit easier. And then what seems like a reasonable stock price for the company? And that's obviously going to be subjective. I do want to mention nonprofit companies, even though the focus of this talk is going to be on for-profit companies. But if you are analyzing a nonprofit company, you would look at their statements, and they've got the 990 forms, which is where they report their statements. And from those forms, you can kind of get an idea of how effectively the firm is managing its funds. And, are they being good stewards of the money that's being donated to them? What's really important is, do they have enough cash reserves to continue to provide services? Because usually they're very mission-based, and so, what happens if their money gets cut off? Are they going to be able to survive for a period of time, and if so, how long? What happens if the demand for services suddenly increase? Would the organization be able to handle it? So those are like a few of the questions that we look at for nonprofit organizations that are a little bit different than for-profit. So where do we find the answers to all these questions? Well, the answers to most of these questions can be found in financial analysis, looking at both the quantitative and the qualitative data, and I have a YouTube video for the qualitative data involved in financial analysis as well. And you can find this information in annual reports that are public for the company, so just go to the company website and look. Usually it's either up top or in the bottom, something about investors or financial information or something like that, and you click on it and you should find several years worth of financial information. And so the annual reports should be found there. Sometimes they're called the 10K reports, and you can download the whole thing. And when you read the annual reports, you want to definitely read the financial footnotes, because the financial footnotes or financial notes that go with the reports really help explain the numbers and perhaps any changes in accounting practices and so on and so forth. So they're critical to understanding the numbers. And so the financial analysis that we do allows us to understand and interpret financial information so that we can make then some informed decisions, and as we said earlier, be able to make some judgments about the company's risk. So, if I were to ask you which engine operates most efficiently, a Toyota Highlander or a Kia Sorento, and let's say the Highlander gets 28 miles per gallon and the Sorento gets 26 miles per gallon. Okay, and that's all you knew up front. What would your answer be? And a lot of people, not everybody, might assume that the Highlander is more efficient because you get more miles per gallon. And so what I want to do is really kind of use this as a metaphor for profits. If one company has a higher level of profits than another, then oftentimes people will conclude that that's a well-run company, or an efficiently run company, and that's not necessarily the case. Basically, there's all these underlying factors that impact those numbers. So in my example here with the Highlander and the Sorento, we've got factors like the weight load of the car. That's certainly going to impact your miles per gallon, the type of terrain you're driving on, whether you're driving city or highway, what grade of fuel you're using, what is your travel speed. So all those things are going to impact the miles per gallon. Those are drivers. And so same thing with financial analysis. And this is more of an income statement type example, but if you have your net income on the bottom, you want to figure out what are the drivers, what is it that exists in the company or in its environment that impacts the net income of that company. So the first statement we're going to start with is the balance sheet. And I'm going to go through each account one by one. It's impossible to do financial analysis if you don't understand what each account means. Also, please note that this is a fictitious company that I just made up, BMC Incorporated, and every company doesn't have the same accounts. So like my account here has an accounts receivables, some companies don't. So not every company will have every one of these accounts. Likewise, there are many companies that will have additional accounts that I don't have included here. And then the third thing to keep in mind is account names can differ. So, I chose popular or widely used names here for certain accounts, but your company, if you're looking at an annual report, might call the same item something slightly different, but it still means the same thing. So unfortunately, there's not a terminology that's used consistently throughout all the annual reports. You just have to kind of hang in with me here as we go through the balance sheet, because unfortunately there's not an exciting way to do this. So we're just going to run through the accounts. The balance sheet takes the longest of the statements. Then I have another YouTube video that does the income statement and the cash flow statement together. Okay, so when you're doing a financial analysis, you want at a minimum the most 3 recent years and take a look at that. For most of my students, undergraduates, if they're taking my financial analysis class, I'll have them look at the 5 most recent years, because 5 years is gives you a better idea, a better trend than 3 years. But with my MBA class, we don't have as much time to spend on this, so I just go with the 3 most current years. Okay, so first of all, what is the purpose of the balance sheet? Okay, the balance sheet shows you exactly what the balance is in each of the accounts, in this case at the end of the calendar year. So on December 31st, 2018, you see the balance of all the accounts. Now in front of you are just the asset accounts, and I've got other slides to show the rest later. But a couple things I want to point out here is you will find that not all companies will close their books at year end. Some will use what's called a fiscal year. So they might choose another year end that makes more sense to them. Usually they're based on what's called a natural year. So for example, universities. Many universities close their books on May 31st or June 30th, right in there. Pick one of those as their fiscal year, because that's the end of the academic year. And so it's kind of a natural end to that year. So it does not have to be December 31st. So look at the balance sheet will tell you what day that they close the books. And then basically think of these account balances that you see as a picture of what those accounts are holding, or what's contained in those accounts as of December 31st. So we'll go ahead and kind of go through those. I do want to comment too, you'll see up top, this is BMC Incorporated, and this is their comparative consolidated balance sheets. Okay, by consolidated, that means it not only includes all of BMC's account balances, but also any other interest that they hold a majority of. So in other words, if they're invested in other companies and they own 51% or more, that is consolidated in this statement. And also notice the number is in millions. So this is a very large fictitious company. Okay, so we'll go down to current assets. And current assets by definition are assets that are expected to be used up within the year or within one operating cycle. So an operating cycle is how long does it take to go from cash to cash. Okay, if you look at most of your current assets, they actually go from one form to another. For instance, a company might buy raw materials inventory. Say we got a manufacturing company, which by the way BMC is a manufacturing company. So let's say they use cash to buy raw materials inventory. Then they use the raw materials inventory to get finished goods inventory. Then they ship out their finished good order to a customer. And so the customer owes the money for that order, so then it goes into accounts receivables. And then maybe after, it depends on what your receivables policy is, maybe after 90 days, then your customer pays you the cash that they owe you on the receivables, and now you have gone from cash to cash. Okay? The amount of time it takes to go from cash to cash conversion cycle, is also, if it's longer than a year, then those balances can be included as well. So for the majority of companies, it's current assets or assets that are going to be used up within a year, but for other for some companies, usually companies that deal with very, very large equipment, manufacture very, very large equipment, it could be longer than a year based on their operating cycle. Okay, so that's what current assets are. We know it's going to be used up, in this case, let's assume within the year. And so you have cash and short-term investments. And here for this company, that's put together in one account because your short-term investments are just your money market accounts. So it's the amount of liquidity, of true liquidity that they have on hand right now. And for some companies, they separate that out. They'll have cash and then short-term investments as a separate item. So I'll just pay attention more to the 2018 column. For 2018, we see the cash and short-term investments of $292 million. And we're not going to really make judgment calls on any of these numbers right now. That kind of comes later when we get into the analysis and do ratios and things like that. But right now it's more just kind of explaining. But I will also talk a little bit about things to watch out for. Okay, the next account's accounts receivables, and that account shows how much your customers owe you. So in 2018, our customers owe us nearly $6 billion. Okay, so quite a bit of money there. And again, not putting a judgment on that. Now, if you look at the trend, you'll see that accounts receivables has increased over time. In 2016, it was a little over $4 billion, then up to $5 billion in 2017, almost $6 billion in 2018. So what does that trend kind of tell us? Kind of think about that. So it can mean a couple of things. It could mean perhaps that sales have increased over the last 3 years. And so as a result, accounts receivables is also increasing, right? So to find that out, you look at the income statement and see if that's the case. Alternatively, it could mean that they're not collecting as quickly as they had before. So maybe their sales are stable, but they're having a hard time getting payment from customers. And so that could cause an increase in the accounts receivables. Also, the accounts receivables is listed really as a net receivables, meaning they're supposed to have taken out what they expect to not be collectible. And so maybe they have a large balance there that's just not collectible, that they've not taken into consideration yet. So there can be a number of reasons you see an increase there, and some of them are good and some of them are bad, right? Because and we don't know the story yet with this company. But if it's because of increased sales, that's probably good. If it's because they're not collecting, that could be bad and maybe not. Maybe they made a purposeful change in their collection policy, in which case you would expect to see that number rise. On the other hand, if they didn't make a change in their collection policy and customers aren't paying, then that's a negative. So you just have to kind of investigate and figure that out. Inventory is the next item. Inventory is going to be different for the different type of firm that you have. For example, for a manufacturing firm, it's going to be a reasonably large number, which is what I have here. And if you look at the financial note for a manufacturing firm, it should talk about the 3 different forms of inventory, which is raw materials inventory, work in process, and finished goods inventory. And so they usually don't separate those in the balance sheet. They usually just go ahead and lump them together. And so that inventory amount can actually be pretty important, because it actually impacts both the balance sheet and the income statement. And let me go ahead and explain that. You want to read the financial notes and see how the company is valuing their inventory. There's 3 different methods. There's LIFO, FIFO, and averaging. So let me show you that. Oops, sorry about that. Didn't mean to. There we go. So here I'm using a really simple example. So LIFO, last in, first out. What LIFO implies is that the last items of inventory that you bought are the first ones assumed to be sold. Now, what physically happens doesn't necessarily match up with the inventory method, okay? It's just an assumption. Under FIFO, the first inventory items that you purchased are assumed to be the first ones out, first ones sold. And under average cost, you would take all 5 of the inventory items, average the cost, and then that would be your cost of goods sold. So as you can see under LIFO, last in, first out, since I have some hyperinflation going here, if I sold items 4 and 5, they're the most expensive ones, so my cost of goods sold on my income statement is going to be higher if I use LIFO, and the value left in my inventory in my balance sheet is going to be lower. With FIFO, it'd be exactly the opposite, right? First in, first out. If I sold 2 items, then the $5 plus the $7 would be my cost of goods sold, and then my inventory valuation would run high on my balance sheet. And under average cost, it's going to fall right in the middle of the 2. Average cost is least used. LIFO was by far and away the most popular form of inventory valuation because it was considered to be the most conservative. However, companies have been kind of moving away a little bit from LIFO because as we continue to work toward international accounting standards, LIFO is not recognized. It is FIFO that's recognized. So a lot of companies are kind of gravitating toward FIFO. Also, multinational firms may use a combination of the 2. They might use LIFO here in the U.S., but then in foreign countries where they have subsidiaries, they might use FIFO. So you can also use a combination of the two. But you need to read in the notes of the annual report, what they use, and especially if you're comparing your company to a competitor, it's really going to matter if they use LIFO or FIFO. So to kind of further illustrate and put the numbers together so you can see the difference in the balance sheet and the income statement. So here we go. So what if we sold 3 of those inventory items? Well, if you're using FIFO, first in, first out, we would assume that items 1, 2, and 3 were sold and that items 4, 5 still stay in inventory. LIFO would be the flip of that, right? We would assume items 5, 4, and 3 were sold and 1 and 2 are left in inventory, and then there's your average cost. Let's put that to numbers. So you can see for FIFO, your cost of goods sold for your income statement would be the sum of items 1, 2, and 3, which is $20, which leaves $20 remaining in inventory on your balance sheet. Under LIFO, notice that excuse me, notice that your cost of goods sold is higher on your income statement because it's assumed you sold items 3, 4, and 5, which are more expensive, and it's $28, leaving $12 left in inventory. And as I told you, average cost just always turns out to be kind of the middle of LIFO and FIFO. Some companies do use average cost, but like I said, most don't. Okay, so we'll move on past inventory. I threw in this account refundable taxes because it seems to come up quite a bit, but corporations do have to estimate taxes that they're going to pay, and sometimes they overestimate and pay a little bit too much in taxes. And so if that's the case, they might have some tax money that's due back to them. So that's what that represents. Prepaid expenses, your company may or may not have that account. A prepaid expense account is just kind of like the name implies, it's when your company has paid expenses ahead of time. So they might have prepaid some rent, they might have prepaid insurance contracts. I mean, there's a number of different things they can prepay. So here's kind of a rule of thumb to think about. Generally, a lot of times, not all the time, and all companies are different. If they're having a really, really good year and they're meeting their earnings estimate consistently throughout the year, or even exceeding their earnings estimate, then what some of those companies might do is prepay some of the expenses so that if they have a quarter where sales aren't as good, they can draw down then against those prepaid expenses to meet their earnings estimate. So generally you see that during good times that account tends to increase, and then during times when they might be struggling a little bit to meet their earnings estimate, you'll see that account go down. So that could be a clue, of how the company is doing right now. So that's kind of interesting. And so you add all that up and you get your total current assets. Before I move to long-term assets, I do want to make one more comment about inventory. I mentioned that this is a manufacturing firm, so it has a sizable amount of inventory. Another type of firm that would have a significant amount of inventory would be a merchandising firm, because they would have to buy all their merchandise and have that on hand, in order to operate. So they would also have a significant amount of inventory. A service-oriented firm that performs services rather than manufactures or sells physical items, they're the ones that are likely to either have no inventory account or a very small inventory account that may just include computer equipment or supplies of some sort, depending on what service they provide. So inventory is a good account to help you try to determine, what type of a firm they are if you didn't know to begin with. Okay, so now we'll move down to long-term assets. And with long-term assets, there could be a number of different things listed there, but again, I've got the most popular ones that you see. First is net property, plant, and equipment. So by definition, long-term assets are not going to be used up within a year. So they're expected to remain long-term. So that would be true with property. So property, by the way, does not depreciate. So it is listed here at historical value. So at whatever price they purchased the property, that is the price that's recorded in the net property, plant, and equipment. However, for plant and equipment, you do have depreciation. And so it's the depreciated value, or what's also called the book value, that's reflected in the balance sheet. So, with plant and equipment, what you're seeing there is the book value. So like theoretically, if you have a really, really old company, you don't see this, but this is just theoretically, hypothetically, I guess. Hypothetically, if you had a really, really old company that didn't own any land, say they just rent their land, they could be operating out of old buildings with old equipment, and their net property, plant, and equipment could actually be zero, and they could still be a viable running company. Because that means everything's fully depreciated. Obviously, we don't see that because companies are constantly replenishing their equipment. But it just emphasizes the point that it's book value that we're looking at. Okay, the next account there is Goodwill, and not all companies are going to have Goodwill. Goodwill arises in the case of a takeover or when you buy out another company. So if Company A buys out Company B, and Company A pays more than the net identifiable value of the assets of Company B, then that difference becomes Goodwill. Okay, and Goodwill could, you might pay more than the net identifiable value of another firm's assets because you want their customer base. That's worth a lot of money, but it's not a physical asset. Or you want their brand name. They've got a great, strong brand name. That's worth a lot. So again, you're not paying for something physical. So, so the only way Goodwill can increase is if you purchase another company. Now, what happens is every year a company has to go through and determine whether their goodwill has gone down in value or not. It's called goodwill impairment. So they have to look and say, okay, this year, did our goodwill from our purchase from companies A, B, and C, go down in value at all? Is our brand still as strong as it was before? Is our customer base that we got from them, still as strong as before, and so on and so forth? And if it hasn't gone down, then you don't have to adjust goodwill. If you feel it's gone up, you still can't adjust goodwill. You can never adjust it upward. It can only increase because of another purchase. If you do feel it has deteriorated some, then you're supposed to figure out how much, and this is all estimated, so you figure out how much you think it's deteriorated by, and you will have to deduct that on your income statement as a goodwill expense, goodwill impairment expense. So the numbers you see there are the remaining goodwill for the company. And then I just put another account in there for intangibles, and depending on the company, they may have intangibles or they may not. Intangibles can include many different things. It could be a copyright, it could be a patent, it could be a franchise. So, it could be basically it's an asset that's not tangible, that you can't touch. So Goodwill is also an intangible, but it's listed separately because it goes through an impairment process. The other intangibles I talked about do not go through an impairment process. They are simply depreciated. And actually, for intangibles, rather than call it depreciation, we call it amortization. So they are actually amortized each year, whether they change or not. So they don't have to go through any sort of, did this increase in value or decrease in value? We just simply amortize it down each year. And it depends, if it's a franchise, it's amortized at a different rate than if it's a patent. It depends on what type of intangible it is. Again, you should be able to see in the financial notes what the intangibles for the company would be. And then I just kind of put other long-term assets in there because you probably see that account. And it's just kind of a catch-all for a bunch of smaller accounts that, they just didn't bother to list separately because they're all pretty small. Sometimes there's a financial note that talks about that, and oftentimes not. And so you total up, you got your total long-term assets, and then you take your total current assets and your total long-term assets, sum those up to get your total assets together. Okay, next we'll deal with liabilities. Okay, so that's kind of the other half of the balance sheet is your liabilities and equity. So here's our liabilities. So again, we start out with our current liabilities, which are liabilities that have to be paid within the year or one operating cycle. So the company may or may not have short-term debt, but if they do, short-term debt generally implies it has to be paid in less than a year. Okay, so this company has $484 million in short-term debt that has to be paid up next year. Accounts payable, that is generally what we call a spontaneous form of financing by our suppliers. So, if in this case we're a manufacturing company, so when we buy raw materials, we're buying them on account, meaning that, we'll pay them depending on what their credit terms are, maybe 60 days from now, 90 days from now. We want to hang on to that cash as long as we can. So, we'll pay according to their credit terms. We want to obey their credit terms because we generally don't want to get on the bad side of suppliers. Again, notice the increase from 2016 to 2018 in that account. So that does seem to imply that perhaps there's a growth in sales for this company. But again, you want to look at the income statement and make sure, because it could also imply that maybe because we're not getting our receivables money from people, we're not able to pay our suppliers, and so we have accounts payable stacking up. Okay, so the next series of accounts are due to the accrual accounting system. So the accrual accounting system is really what kind of makes accounting complex, but at the same time it provides us with so much information. So to give you an example, I just took a few accrual accounts here, but you have the cash accounting system and the accrual system. Let me check something here. Oops, no. Okay, never mind. I thought, sorry about that. Well, I'm sorry about that. I can't get that slide to come back up. But let me go ahead. I mean, you can back up and look at that slide, and you've got the slide deck too. But let me go ahead and explain that the accrual accounting before I get into the equity. So with the accrual accounting, what you do is you You log a revenue as received once the item has been shipped. Not necessarily when you get the money, because if it's been shipped and your customers have 90 days to pay, you get to log it as a revenue immediately, even though, and then what's going to happen is your accounts receivables is going to increase until the customer actually pays the cash. So when the customer actually pays the cash later, accounts receivables will go down and your cash account will increase. So that's the way the accrual system works. It's different than the cash accounting system. Like you and I work on a cash accounting system where you know, like think of a checkbook. Checkbooks are almost obsolete now, but when you get paid, you mark in your checkbook money coming in, and when you pay bills, you mark in your checkbook money going out. That's a cash accounting system. And if companies did that, we would have no idea of what their cost structure looked like. So that's why instead of doing it as a cash accounting system, we use an accrual system that says, okay, when we sell a product, let's book it as a revenue once it's shipped, and then we'll figure out what was the cost of producing that product, and that's going to be our cost of goods sold. So we're going to match our cost with our revenue, and so by matching, you know, that's called the matching principle in accounting. By matching that, we get a much better idea of the cost structure of the firm. So because we have that accrual accounting, you'll have accrual accounts that have to be closed out at the end of the year. So for example, the accrued wages. What that means, that balance there that's under accrued wages, simply means that this is the amount of wages that the company owes their employees, but since December 31st wasn't a payday, then right now it's a short-term liability. You know, as soon as it's a payday, that debt will be wiped clean. Okay, and that's true of all accrued expenses. Accrued dividends were earned by our customers, or I'm sorry, by our shareholders, but because it wasn't a dividend payment date, we haven't paid those dividends yet. And so that's just the balance, you know, that's accumulating until the dividends are actually paid. So, and that'll all be done within less than a year. Then you get down into long-term liabilities, and so your debt, which is generally, debt for corporations is generally in the form of bonds, and so those have maturities anywhere from 15 to 100 years. So, you know, it's not going to be due for a very long time. Financial notes will explain and will show you the different bonds that have been sold and what the interest rate is on each of the bonds and when they're due. So you can get all that information in the financial notes. Now, if there's a portion of the long-term bonds that's due to be paid up this year, then that portion will be moved up into the current liabilities, and it'll be current portion of debt, called current portion of debt, moved up into current liabilities. And then also under long-term liabilities, your company may or may not have this. Not all companies do, but if your company offers any benefits, or you know, whether it's a retirement payout or just medical benefits after retirement, but if they offer any sort of retirement benefit at all, then the companies have to start saving up for that. And so that's what the post-employment retirement benefits account may be. Now, on the other hand, if your company doesn't offer any benefits upon retirement, in other words, they might do what's called a defined contribution plan, where instead of promising you some certain benefit when you retire, they instead say, hey, listen, we'll contribute to a mutual fund of your choosing every payday, and it's up to you to manage your money for retirement, and it's not a liability for us. You know, it's just part of your wages that we pay every 2 weeks, every week, or every month. And that's the way most companies are going now. But some companies do have a defined benefit plan where they promise, you know, a certain percentage perhaps of your pay at retirement. And if that's the case, then that's a liability that has to be indicated on the balance sheet. And there will be a lot of financial notes that will explain what that liability is. Okay, and you know how that liability was figured. It is definitely an estimate. They can't know for sure how long their employees are going to live, or their retirees are going to live, exactly what date their retirees are going to retire, when are they, what rate of return are your assets going to earn that you're setting aside. So everything is estimated, but you know they usually hire actuaries to come up with those numbers. Okay, so total up your liabilities. You have current liabilities and long-term liabilities, and total it up to get total liabilities. And then we go to equities. And again, I apologize, I couldn't back up. That was strange. So now we get to the equities page, and you'll see that we have common stock there first of all. So that common stock amount that you see there for little over $1 billion represents all the common stock that's been sold by the company since the inception of the company, and it is recorded at the value at which the common stock sold. So, you know, as you can see here, it looks like between 2017 and 2018 that they did issue some more stock. Because that balance went up. Notice the balance went down from 2016 to 2017. So how can that happen? Well, many stocks go through and buy back some of their stocks, and so that could be, that's most likely the reason you saw that decline. In fact, if you go farther down and you see Treasury Stock down there, you can see Treasury Stock is stock that the company is buying back. So it's when they're buying back their own stock that's referred to as treasury stock. And so you can see that they actually bought back a lot of their stock in a good chunk in 2017 and even more in 2018. Now, one question I'm going to pose is, look at 2018, and if the company has only issued $1 billion in common stock, how is it possible that they've bought back $1.5 billion in stock? They've bought back more stock than they've issued? That's not possible. So you may know the answer to this. The answer would be that treasury stock is going to be recorded at the purchase price. So actually that's good news for this company, because what it implies is that when they've repurchased their stock, they've done so at a higher price than when the stock was originally issued. So that means the stock price has been climbing for this company over the years. So that's a positive sign. Retained earnings, the second account there, that's the amount of money that the company has retained from their net income since the inception of the company. So keep in mind, when a company generates net income or net profit, okay, they can only do two things with that. They can either pay it out in the form of dividends, or they can retain it and reinvest that money back into the firm. Okay, and what most companies do is they do a little of both. They'll pay out some dividends and then retain some of it to reinvest into capital investments. And so you can see here that BMC Incorporated, they have retained $5 billion of their net profit since the inception of this company. Okay. Now, if the company were to have a net loss, the net loss would be taken out of retained earnings. So that's if you ever see a reduction in retained earnings, it's most likely due to a net loss that the company had that year. If you have a company that has subsidiaries in foreign countries, then you'll see a foreign currency translation account here, because as they translate currency from one form to another, sometimes they're going to lose some money, sometimes they're going to gain some money. In this case, they obviously manage it quite well. It tends to be a gain every year, and so they make some extra money in their currency translation. I went ahead and added this other adjustment account because that has popped up on some students' statements. Minimum pension liability adjustment. You may or may not see that. That goes back to for the companies that offer like a defined benefit plan, or some kind of post-retirement benefit. If they're underfunded and they're too leveraged because they haven't put enough money away for to cover those expenses in the future, they might go ahead and take a chunk of money then out of equity to help them catch up. So here you can see in 2016 they took $100 million out of their equity account to help fund their pension account. Okay, and so we already talked about treasury stock. So when you sum up all the equity accounts, you get total equity. And when you take total equity plus total liabilities, you get the amounts that you see there at the bottom. For 2018, $20,756,000,000, which happens to equal total assets, which also came to $20,756,000,000, which is why we call it the balance sheet. Assets have to equal liabilities plus equity. So thank you for listening. That's the balance sheet in detail. If you're interested in learning about the income statement and the cash flow statement, and for my class, they have to, look for my next video. Thank you. Bye-bye.